template, taxation of the digital economy, international developments, and what we have in the local legislation. Now, all of us, I'm sure we are in this space. Even as I'm speaking now, I'm sure there are people who are enjoying any of these services. So what we are being told, and you can access this website called Domo. Every year they update in the previous year, what is the level of consumption of digital services? So Mwalimu, sorry, it's not aligned to the scholar, but I put it here so that we can, just for purposes of our class. Yeah?
That's
in
okay.
2025, yes, in 2025, 16,000 videos were being uploaded into TikTok every minute. 16,000 videos. In 60 seconds, there are 16,000 videos. You can break that into seconds. And that shows you how people are interacting with the digital economy. If you look at the number of video views in 1 minute in the world, I don't know how many in the world. Are we about 6-7 billion, or we are already 10 billion? Okay. I know India and China takes the lead.
And Nigeria.
But yeah, okay, and Nigeria. So you are seeing 3.47 million video views on YouTube every 1 minute. If you add that to reels that we watch, I think I've always told some people that reels is taking a lot of their time. And you know, these guys know how to make you be hooked into reels in the book. You watch this video and another one comes and another one comes and say Mwecheche and another one comes and say Top Shotter. And you know, you can't just stop watching it. And that basically is our interaction with the digital economy. And the digital economy is not just growing alone in Africa, in the world, in Kenya, in the villages. You've seen the shoshos who are also TikTokers. And so you can see the number of TikTok videos or that are uploaded in 1 minute. Now people have gone into AI. If you check 6 years ago, you couldn't see Gemini AI's, Google's AI's Gemini visitors. 8,000 visitors in 1 minute. Now we've not gone to Grok. We've not checked what is happening to ChatGPT. We've not checked what is happening to whichever other AI that exists. So what we know is that we are interacting with the digital space. A lot of it is penetrating into our homes, houses, and spaces. But the rules that pertains to taxation are quite old. And just a few things I put up on what is estimated to be of the digital economy in the next few years. Okay? So if you look at what is going to happen to the digital economy in the next few years, you're able to see a lot more. Okay? You're able to see that it's really expanding. But even as it expands, are the tax laws expanding at the same rate? Or it is not at the same rate? That's basically what everybody is asking. Yes, they're expanding, but is it expanding at the same rate? And you can see all that we keep on enjoying every day. Okay. Now, I'm trying to move my slides a bit faster. What has happened? It's not moving.
Technology.
Or it has moved on your end, Mwalimu, but not my side.
Afana bado.
So I need to.
It shows e-commerce in Africa.
Yeah, it's e-commerce in Africa. Let me see. I might have to stop sharing and reshare.
Okay.
Just to ensure it's okay. In case of anything, just tell me if it's visible to all of us.
Yes.
Okay. I think that's fine. Good. And I keep admitting people. I hope I'm admitting the right people.
No, don't worry. Okay. I'll do that. You just concentrate on the data. I'll do my part here. Yes.
No, sometimes it interferes with my words. I might forget a word, but it's okay. Now, so generally when we talk of the digital economy, we are able to see a huge e-commerce growth. When I shared the Domo website, you can see the number of, let me just go back there. You can see the number of shipments that happens every 1 minute. Okay. What happens when people are buying things, travelers are booking Airbnb, people are buying on eBay, you can see that the numbers are really going up. Okay. So when we talk of that, there's a lot of e-commerce growth with the advancement of technology. I don't want to belabor on the social media penetration. Kenya, we know the mobile money M-Pesa has transformed digital inclusion. Okay. And I saw yesterday, even the M-Pesa app has suddenly changed with a lot of other features. And of course, there's also global trends on the growth of the digital economy with, a lot of transactions going digital. But are we able to do tax-based expansion? Can it raise additional revenues to the government? And something like that, that's what we'll be discussing. So with the growth of the digital economy, okay, there's one change in the environment in terms of complexities, comparing what used to happen in the olden days, the tax laws, and now what we have as the digital economy. How do you move the taxation of the traditional economy to the new digital economy in a way that, one, it doesn't impact consumption of the services, okay? It leaves the industry to grow, and two, it can generate enough revenue for the government. Okay, I know there's a lot of that balancing act. So what it says that we have to change the policy, okay, facilitate the environment, provide certainty, and also to ensure there is sustainability in terms of growth. Of course, that aligns to the Adam Smith principles in a good tax system. So many governments are currently focusing on taxation of the digital economy. Actually, whenever you visit any international forum, a lot of discussion is on digital economy, digitalization of the tax administration, digital tools, cryptocurrency, and such like things. So there's a lot of focus in this area. What are some of the challenges of taxing this environment? I think this one you now need to be a bit keen. One, when you look at the definition of a PE, which I'm sure you've gone through, whether you're looking at the Kenyan Section 2, or you're looking at the OECD Article 5, the UN Article 5, or any other treaty, we talk of a PE is a physical, not really a physical, but it says that a permanent establishment is a physical place where a non-resident is partly carrying on or fully carrying on business. So when you define a P, you are talking of physical presence. When you are looking at residence, which was the basis of taxation based on the four economists way back in the 1920s, 27, they were also talking of a resident. If you look at resident in terms of Article 4 of a Model Tax Convention, or even Section 2 of the Income Tax Act, it talks of, for you to be a resident of Kenya, if you're an individual, you must have been present in Kenya. I know you are law students, you know the meaning of Kenya in the Continental Shelf Act, and we also know what is the meaning of to be present. Okay, and so even countries that have tried to come up with digital presence haven't seen a lot of success because of the fixation that we've had over a period of several years, now close to 100 years, where taxation has been based on physical presence predominantly. For transfer pricing students, you know that when you do a functional analysis, okay, for the experts in transfer pricing who are here, when you do functional analysis, you are basically looking at outbound activities, inbound activities, primary activities, secondary activities. You're looking at what is the company doing, okay? The company is either manufacturing, the company is distributing, the company is having assets, but the digital economy has challenged that. In the digital economy, I always ask people, were you ever trained by TikTok how to do TikTok videos? Most likely no. So somebody gets into TikTok, it says, this thing is so nice, can you come? So there's a lot of supply side in terms of a demand side value creation, apart from supply-side value creation. The company, yes, they do something, but the value of some of these items grow by the demand side, the users themselves, what we call user participation. As the users interact, as the users participate in the platform gets more valuable, okay? And that it was never contemplated by using the FA analysis, the functions, assets, and risk analysis in transfer pricing. There's also a challenge of how to characterize some of the income. For a long time, we've been belaboring, for example, if you are on TikTok and your favorite, or you are the TikToker, and you are live, and people are gifting you. And you know, in TikTok, you can gift a lion, you can gift a diamond, you can gift so many things, yeah? I'm not saying I'm in TikTok. I've just learned some of these things. So if you are gifted a lion, is that income a gift? Because in Kenya, we don't tax gifts. Or is it a business income? And because it is coming in form of a token, is it money? I always like the way VAT Act defines goods. Is it, no, services, anything that is not a good and is not money. So if you say the gifts you get through TikTok is not money, is not a good, is it money? Is it a token? Is it a gift? Is it business income? How do you tax it? So some of these challenge our traditional way of looking at taxation. When you look at Section 3 of the Income Tax Act, it lists the sources of income which are subject to tax. Business income and all that. You go to employment for services rendered, things like rights granted and all that. So where will you place where people gift you as they enjoy watching you? Okay, you can say maybe the subscription, it starts to split hairs basically. There's also the key thing of misalignment where profits or value is created and profits are booked. I think that's an old issue about base erosion and profit shifting. For VAT, where's the destination of the services? When you go to the VAT Act, Cap 476, remember VAT is charged in the country or in the jurisdiction of final consumption. Where is the good finally consumed or the service finally consumed? There are certain services in the digital space that it is not easy to pinpoint where it has been consumed, especially for services. I don't want to belabor about it because there are a lot of other case laws on the issue of meaning of to consume or to use. So digital characterization has been, we see some of these companies huge. There's a lot of use of data. Users interact like we do in this platform now, and that creates challenges in taxing the digital economy. So one, they are borderless, scalable without mass. These companies can operate in more than 200 jurisdictions in the world. They don't need to be physically present in those jurisdictions. Okay? In the industrial era, the economies of scale was a very key item. And I'm sure with those who've done a bit of economics or accounting or finance, we talk of economies of scale. In the digital era, we talk of economies of speed. How fast can your goods reach? How fast can people watch breaking news? And you can see it has challenged even the traditional media. By the time the media is putting it out in the newspaper, it is already not news. Okay, I don't know how we call it. It's not news anymore. There's a lot of use of intangibles. Okay, you can see the number of patent holders just within 11 years. That's up to 2018. Smartphone domain and the number of patents that they hold. Samsung, as of 2018, held 4,095 patents. Many people don't know that if you pick a Samsung with the Edge, Samsung Edge, the way that Edge is a patent on its own. The way you swipe from left to right or right to left, up, top, bottom up, that is a royalty item in its own. Okay, and you can see all that going into, including Microsoft. And now there are many other companies or phones. So there's a lot of and heavy use of intangibles in enhancing the digital economy. And I hope people have seen the way Samsung and iPhone each took each other to court over infringement of patents and things like that. Of course, the user participation is very important. How does the user participation operate? You have to create compelling content. How do you create compelling content? When you create compelling content, people are able to consume, people can give you feedback, you can go back again and all that. How do you leverage on social sharing? Okay, even companies have known that for them to do a good advert, they look for people who have viewers. They don't come to Nickson who have maybe 1 or 2 viewers. They go for people with 10,000, 100,000. Okay, engaging participants, very important and all that. So in summary, these are some of the characteristics of a highly digitalized business: the scale without mass, reliance on intangible, and user participation. I'm sure I'll share with you this so that you can just check later. Look at the business model of Amazon. And then you tell me whether the 3 characteristics of a highly digitalized business is present. And Mwalimu, allow me to have feedback here. If you look at the Amazon business model, from partners, supply side, distribution, demand side. And on the demand side, you can see some of the users of Amazon products. Either you can be using the Amazon platform to import or buy. You can also be using the Amazon platform to watch video, Amazon Prime, the Fire tablets, the Kindle books, and all that. So there's a whole model or chain which then feeds into the 3 main characteristics of a highly digitalized business: scale without mass, use of intangibles highly, and then the user participation. Mwalimu, can you allow me to open it up so that maybe 1 or 2 students could just comment how they see a highly digitalized business characteristic in relation to the Amazon business model, or even the way they know Amazon?
Absolutely. In fact, just pick on any one of them.
I want to leave it open.
Guys, you can just unmute yourself and then have that engagement, please.
And the business models are available at garyfox.co. Feel free, just unmute and give it a go.
Let me just start with Judy Mbugua. I'm mentioning you this morning, and now I see you first. I see you first on my my list.
Good.
Yes.
Yes. Thank you, Senior Nickson, for that. And well, but then I also need to know so that I can give you proper feedback on exactly what you want to know regarding how we see the Amazon business model. If you could be clearer, please.
Any comment on the Amazon business model to the 3 characteristics of a highly digitalized business? The 3 characteristics are there's a high user participation, there is intensive use of intangibles, and also scale without mass.
Yes, thank you so much. Thank you for that, Senior. So now I will start with the first one for the high user. Of course, you know now with regards to the users for Amazon, we have the purchasers, the customers, the demand side, where we have so many customers. I mean, even I can purchase something from Amazon from wherever I am. And at the same time, we have so many sellers in the supply side. And I mean, anyone can also do that. And really, there's very high user usage. There are very many users in both the supply side and the demand side. Regarding the IP, we have the platform itself, where it is an intangible, and by the way, Nickson, and it's something really that you need to address later on. It has been an issue of contention, where also Amazon AWS issues a platform where people can store data, and they talk about being subject to SEP tax, significant economic presence tax, and therefore not subject to withholding tax. They are reading it in the reverse because of the exemption of SEP tax. But anyway, that is beyond the topic of discussion. So yes, we have a lot of this IP. We have the platform itself that is used by Amazon to connect the buyers and the sellers. So as a confession, one day I tried to be a supplier in the supply side of Amazon, and it's totally different in terms of the platform, the user interface, and everything. And also I have tried that as a customer. So of course there is very high usage of the IP. Then there is scaling. It is huge. And really you can see you can do the shipping from anywhere. You can buy and sell from anywhere you want. So that is what I can say as it now. Thank you.
Super, very good. And for those who are interested, you can read the case of Amazon in Japan, where I think Japan had contended that they formed a PE. The treaty between Japan and the US, Amazon had exploited that treaty in terms of the exemptions. That is Article 5.4, that they were using the warehouses in Japan simply for storage. And when you look at that Article 5.4 talks of the exemptions to a PE, including storage and things like that. So it's also a very interesting case just to see how some of these issues are challenged in the digital business. So that's an assignment. I don't know whether to call it estate work or homework. So Judy, you are very spot on. The issue of AWS and cloud storage, withholding tax, SEPT, royalties, software, maybe I'll get time to talk about it towards the end. Mwalimu, anything you want to say? Because after that, I think there are 2 or 3 models which I'll not go through.
No
then
problem.
We get in next
Yes,
cases.
that's okay. Thank you. I just wanted to highlight the definition of scale without mass for some of the students. I just want them to understand that when Nickson is talking about scale without mass, what you need to understand about it is that it describes, the capacity of a digital business like Amazon to achieve what, in the language of the OECD's interim report, is that it achieves a deep, sustained, and commercially significant engagement with the market jurisdiction without the physical footprint that our traditional international tax rules treat as the prerequisite for taxing rights. So when you look at the slide and you look at that column on supply side, all those services that are being supplied by Amazon, they actually feature within the concept of scale without mass because they cannot be ring-fenced to any jurisdiction. You can access them from anywhere, and that also touches in on the perspective of user participation. So I just wanted to provide that small context as you continue, Nickson.
Very, very elaborate, and I like that, Mwalimu. So allow me you can go through Google as well, the same business pattern. You'll see their value proposition and how we enjoy the YouTube and many other things. Many people just believe that Google provides the YouTube but and the search engine. Google provides more than that. There's a lot. Look at even Google AdWords.
Yeah.
There are companies that actually subscribe to Google for specific searches, not the Google search that we are generally used to. And so there are a lot of services, magazines and blogs. Okay, so very important that you can see that. But again, content monetization is also one of the very important value propositions for Google. I don't know how many people have content in YouTube. You can earn something. I told you the essence of this class again is to make sure we are business people at the end of the day. We need to earn something so that we don't walk with the increase in fuel prices. Okay, then Uber model. Oh, I saw Uber increase their prices, and people started saying, no, 3 kilometers is too short.
We'll
It
walk.
can make us hit the 10,000 steps in our smartwatches. And that's still the digital economy. Okay, so you can look at the model as well. Now, after looking at all whatever is in the models, the question is, how do you tax the incomes of the above entities? How do you tax it? Of course, okay, we've known that is how they operate. We've known that the law does not catch up with them in the traditional sense. How do we tax them? And if we were to tax them, how much should we tax? Do we tax gross? Do we tax net? Do we tax 2%? Do we tax 50%? And I'm sure, Dr. this is one of the questions you are grappling with at the UN framework, okay? Then what about VAT? Do we continue with the traditional reverse VAT, Section 10 of the VAT Act, or do we let them charge VAT? And then the VAT flows in line with the OECD VAT GST principles. These guys are not in Kenya, scale without mass. If they refuse to comply, what do you do? Do you go to US and tell them, you guys have to pay? You know, we are not like the US where we can go and arrest a president of another country. So it means if these digital companies were in Kenya, Mwalimu, you know, the president of the US will come for them. Porters will actually come for the directors if they fail to pay. Okay, if they can come for a president, they can come for anyone.
Yes.
Okay. So what is the best approach? Do each country tax them in their own way, or do we do a multilateral approach to taxation? Which is better? They are not in our country. They are getting revenue from our country. How do we tax them? I think that is now the gist of our presentation. In the next few, a lot of options have been mooted in order to tax the companies. Digital service tax, I'm sure you've heard about this. Kenya and a host of very many countries, including the EU, have had digital services tax, Canada, and also the UK. Okay, equalization levy, that was done by India. Some people do hybrid equalization and the DST. I think India has done that. And then a number of countries are also now moving slowly into significant economic presence. And not many people are aware that significant economic presence is akin to having a virtual permanent establishment. And of course, there are a lot of variations on how the same is done. Maybe I'll explain it shortly. There's also been the UN double tax agreement model, you know, saying, why don't we use an Article 12B, negotiate a tax treaty and tax profit or gross based on how you agreed during negotiations. Then there's the new kid on the block, Article 12AA or AA, where we are saying digitalization has benefited everyone, both real digital services, we call them ADS, automated digital services, and others. Why don't we tax all these services that has been enabled through digitalization? And then I don't know why I named this the global approach. I don't know whether we should change it to inclusive framework approach or the OECD approach, where we have what we call Amount A. I'll be talking very shortly about it, and the issue of VAT. Not to mention issues around withholding tax on content monetization, issues around digital asset tax. Some people call it virtual asset tax, the issues of cryptos and all that. Now, when you go to the Income Tax Act, I think this is just a summary of what I've mentioned. All those options that I was mentioning, they're all there. But when you come to the Kenyan context of digital service tax, so Kenya saw the gap, as was in the OECD report in 2015, that these companies are able to get profits, get income from our countries without setting foot, and the traditional laws are not able to catch up with them. So what the option Kenya came up with was digital service tax. from January 2021. So any non-resident who derived income from Kenya or accrues, then they're supposed to be taxed. The services specifically targeted at the internet, electronically or digital marketplace. But again, there's been a very good debate. When you look at Section 12E, whether the traditional DST or now the current SCP, it talks of services provided through the internet, electronic, or through a digital marketplace. Does it mean that the channel of provision is what is important, or the service in itself? Because you are legal students, I think that is a very good debate. Maybe somebody can do a paper on that, okay? Are we looking at the channel, or we are looking at the service itself, or we are looking at both the channel of delivery and the service itself, okay? So the rate was modest, 1.5%, because it was important to have a nexus for the non-residents and what they derive in Kenya. And that nexus was achieved by amendment of Section 3, together with what is in Section 12. You know, there's a very interesting case law. I'm trying to get to the name. Yeah, it's called Motaki Shipping Agencies versus KRA. You know, it's the law that said, the ruling, it must have been a High Court ruling, that you cannot just have something planted after Section 12. So for you to have a taxation connection, what we call nexus, it must be in Part 2 of the Income Tax Act. That is between Section 3 and Section 12. The rest of the sections are more of highlighting and doing something like that. And I think what the judge was trying to achieve is to say that the act is a very organized act where one part feeds to the other, and you cannot just jump the part simply because you want to tax something. So it's a very deliberate arrangement in the various acts, and I think it applies to all the acts of parliament that we have. So DST has been implemented in several jurisdictions, but now in Kenya we have what we call SCP, okay? SCP has many variants. I'll show you those jurisdictions that have implemented the DST and SCP. So SCP has many variants: Kenya, India, Colombia. I think there's some, Zambia is coming up with their own SCP now. Rwanda, I was engaging Rwanda in February, and Daktari, we coined their word. When you go to the Rwanda, they call it Order 50. Order 50 must have been of 2024. They had talked of if a person has substantial national presence. And you know, Kenyans being Kenyans, I gave them the name SNAP. And I'm sure they have picked it up, they're happy. So they are calling it SNAP tax. So you'll not see SEP in Rwanda. You'll see maybe SNAP in Rwanda, because they talk of substantial national presence. But SEP traditionally speaks to significant economic presence. So if a company is having a significant economic presence, then they are subject to this tax. Two ways of looking at significance, three ways actually. You can look at the number of users of the services of that non-resident. You can also look at the amount or the value that they derive, but there's usually a third one, like in Nigeria, they talk of if the company uses .ng. So if a company has a .ke in the provision of their services, and they don't have physical presence, I don't know if the CA allows that through the ISPs, the internet service providers. Well, that can be a debate for another day. Then there's also another variant of SCP. Do you charge the actual profits, what we call allocation or apportionment of profits to the country, or do you do deemed? So Kenya, the policymakers decided to go with the word deemed profit instead of, thank you for showing that, Mwalimu. So instead of taking the actual profits made by the non-resident, and the challenge with the actual profits will be, how do you know that you're being given your fair share? How do you know that is the profits allocated to your country? Can you audit their profit allocation mechanisms? So in Kenya, we decided to do the easiest. And you know, Mwalimu, one of my friends told me that in KRA, for a very complex solution, we come up with one simple but stupid solution for a complex problem. So I don't know whether that is true. Judy, I'll ask you now that at least you can see things within from outside, whether we give complex questions, we solve it with simple but stupid solutions.
Absolutely. That is true.
Are you sure?
Oh, 100% sure.
I think we are going to pick a fight just after this, and Mwalimu will be the mediator.
It's
So
okay,
the
no problem.
profit is then taxed at 30% in Kenya, but in most countries, they'll just do it at their corporate rate. So there's a good reason as to why Kenya moved from DST to SCP. I might not explain so much, but there's also a very close link between SCP or DST and withholding tax. And that should have spoken to your question, Judy, earlier. We'll address it. Now, when we talk of the countries that have DSTs or SCP, they are all listed there with their rates. I think when you get time, you can see which country, what is the rate, what is the scope, and I'm sure this list is more than current. But I've attached a document that highlights all those countries, I think, as at 2025. In the inclusive framework, there's also been, remember I asked, when countries want to tax the digital economy from a corporate tax perspective or income tax perspective, do they do country specific or they can do global? So the OECD has been advocating for a global way of taxation, and I think it's similar to what is happening at the UN discussions, that if this income stream can be taxed from a global perspective, then it causes two issues. One, it will help to avoid double taxation, avoid double non-taxation, that I bundle that as one, and also the issues around coordination. I think coordination is very important because these countries, these entities are never physically present in the jurisdictions. And that is why within the base erosion and profit shifting plans, number one was dedicated to the digital economy. And of course, that number one has many other items, what they call Pillar 1 and Pillar 2. So Pillar 1 speaks directly to the digital economy. Not many people know the link between the two, but when we talk of Pillar 1, it's actually the substitute to either digital service tax or SDP, okay? So this is a summary of what Pillar 1 required. Pillar 1 required that instead of looking at companies from physical presence, let us look at them from a market perspective. So long as a company has a market in a jurisdiction, they should be able to pay some tax to that jurisdiction. So if you master that, I think you're okay with the principle under Pillar 1. That so long as you have a market in a jurisdiction, you should be ready as a multinational to leave some profits in that jurisdiction. Then now it goes into the mechanics of computing those profits. Unfortunately, because it was a new rule, the turnover was kept so high so that only a few companies, about 120, would be subject to the Pillar 1 taxation, what we call Amount A. I'll not go into Amount B for today because of time, but there's a lot in Amount A. So when Amount A was then mooted, then you're looking at what is the scope? Who should be within Amount A? One, you should be having a global consolidated turnover of 20 billion and above. Then there is a profit level. Then a portion of that profit is what is then dedicated to each country where the multinational has a market, not physical presence. Then how do we determine the tax base? So there's a whole rule on how tax base is determined, and also a whole chapter on how to know when revenue have been sourced from your jurisdiction. For example, in the initial discussions, it was very clear that the Amount A was targeting digital companies, purely digital companies. But because of course, geopolitics, then it was agreed that every sector of the economy has enjoyed digitalization. And therefore, this tax ought to have applied to all multinationals, provided they met the revenue threshold the profit nexus rules, and all those other rules that were then set. So this amount A would have enabled Kenya, for example, to collect tax from Taiwan Semiconductor Company. Okay, why? Because according to the revenue sourcing rules, for intermediate goods, the revenue is deemed to be sourced where the final goods in which they are incorporated is sold or consumed. For example, now we are enjoying use of a laptop or a phone, depending on which gadget you've used to join. That gadget has a semiconductor from Taiwan Semiconductor Company. And because that gadget is finally sold in Kenya, Kenya would have been entitled to a portion of profits from Taiwan Semiconductor. Another good example would have been Coca-Cola. Coca-Cola does not pay any tax in Kenya, at least from what I know, because they sell their concentrates to the bottlers. The bottlers will pay for the concentrate, which includes royalties. And of course, there's a very interesting case of PepsiCo. Maybe for international tax, those who love tax, international tax. Last year, we were waiting to charge taxpayers who have been using what we call royalty embedded goods. Because in a case of PepsiCo, it must have been in Australia, the court just before the Supreme Court in Australia, you know, they have their own way of naming their courts, which I don't know, had said that the PepsiCo was supposed to pay withholding tax on the royalties, removing the royalties from the goods. And so as KRA, we were waiting for the Supreme Court ruling so that we also start collecting the same from Coca-Cola, from Pepsi, from Unilever, from so many companies, until the Supreme Court in Australia overturned that ruling and said no tax. Okay? So what it means is when Coca-Cola sells their concentrate, it sells it with the royalty in it. But they don't declare any corporate tax in Kenya because the goods come to the port, the bottlers pay for them, do their mixing, and then we get the Coca-Cola. But with amount A, Kenya would have been entitled to a portion of the profits that Coca-Cola made because Coca-Cola Atlanta makes or manufactures an intermediate product whose consumption then ends up in Kenya as Bambucha, you know, Obey Your Thirst, and those other, you know, very interesting Coca-Cola. Okay, so that was a brief about what amount A is about. It was to ensure that multinationals, which are very large, have some level of profits, pay some corporate tax in any jurisdiction in which they have a market. Of course, there was a very complicated chapter on elimination of double taxation. It was the start of the stall of the discussions on amount A. I think India, Colombia, Pakistan had an issue when the topic of withholding tax crept into the discussion, because the argument was, if a country is already taxing withholding tax, collecting withholding tax at 20%, it means they have collected everything, including any profits that the company would have made. So those are some of the discussions. I've said amount A, I'll not deal with it today. So this is just a rundown. What was it in amount A? Scope, what is involved in the nexus, what is revenue sourcing rules, which I've elaborated with the case of Coca-Cola and also Taiwan Semiconductor. How do you determine the tax base? Because there's a lot of accounting here. So if you're a lawyer and accountant, this is your area. How do you allocate profits? How do you eliminate double taxation? How do you resolve the dispute? And dispute resolution was one of the most controversial topics, because one of the topics, one of the rules requires that any dispute must be resolved in a mandatory and binding manner. Of course, after developing countries fight, they had also an elective option. And then how is it implemented? There must be an MLC, multilateral convention. Unfortunately, the multilateral convention required that where majority of the multinationals come from must ratify and implement. And the US accounted for about 47% of the multinational. And the rules required that for the multilateral convention to apply or to be effective, 60% must be achieved. So that means anytime US was not signatory, did not ratify, then the MLC falls flat. And you've seen that in the current geopolitics, especially taxation. So I've left an example there for your review when you get time. Just go through it just to get a rough idea. But this is a very simplified example. Pillar 2 deals with global minimum tax. Many people do not know that there's really no relationship between Pillar 2 and the digital economy, even though they are all housed under base erosion and profit shifting action 1, which is digital economy. But Pillar 2 is basically about minimum taxation, that any multinational operating in a country should pay at least a certain percentage as minimum tax, what they call the global minimum rate. And I think we've implemented this under Section 12G of the Income Tax Act, what we call the top-up tax. In technical terms, they call it qualifying domestic minimum top-up tax. In addition, there was also a provision where when there's a withholding tax and there's a treaty, that income stream, outbound or inbound, should be taxed at least 9%. So if there's a treaty giving rise to a lower tax than 9% on both ends of the source and the resident jurisdiction, then the subject to tax rule will then kick in. So this is an illustration of the global minimum tax and also the subject to tax rules. Of course, there's also another one by the UN, what is called a subject to tax rule, which is a bit more comprehensive. So this is how to compute the global minimum tax. When you get this presentation, you'll be able to go through it. I'm just going a bit fast so that we save on time. Allow me to dwell just 1 minute on this example. So you have a company. I don't know whether you are able to see my cursor. There's usually a pen somewhere. Let me see if it can annotate somewhere here. Yeah, good. So you have a country A, which has the ultimate parent entity. Then there's a market. Country B is a market jurisdiction where they sell their items, okay? And there's a country C where they have a PE, and there's a country D where there's a sub-market jurisdiction, and an entity E, which is a low-tax jurisdiction, but has some residual profits. So you're looking at those islands where there's little tax. So in this case, country B, which is a market jurisdiction, would be required to pay amount A under Pillar 1. If there is no PE, there's no subsidiary, they will still be subject to Pillar 1 amount A. Even if they have a subsidiary, we will still seek to collect tax of the entity A, which relates to the market. Country C, there's a PE, might fall, if there's a PE and there's a market, they can still have under Pillar 1, and Pillar 2 will also apply if the taxes they are paid effectively is below 15%. And then subco, the subco in jurisdiction D, again, Pillar 1 and 2, and country E, where there's low taxation, you can also have Pillar 1, amount A, and Pillar 2 on the global minimum tax, because it's a low tax jurisdiction. So very important. So if, for example, you are consulting for a multinational, and you know they have this kind of arrangements, then definitely the discussion on taxation of the digital economy is actually for them, okay? The discussion is for them, and it's important that they take into account the discussion that we're having now, okay? So what has happened to my pen? I need to rub now. Somebody might think there was a CBC here. Any comment before I move to VAT? Mwalimu, any comment?
No, none from me, unless the LLM candidates have a question. They're free to always, guys, you can just unmute yourself and ask your question, right?
Yeah, please ask if you have a question on what I've discussed. Judy, your question is still here. I'll work on it. It's a long one, maybe. I want to move to other taxes in the next 5 so that we leave the rest of the time, maybe maximum 10. We leave the next 10 minutes for Q&A. If possible, you can also type. I'm sure I'll be able to see. If you type your question, I'll be able to pick it up. So as I mentioned earlier.
I have one question.
Yes, Nathan.
Yes, I wanted to ask whether the multilateral convention where Pillar 1 and 2 are based is in force, or whether it was suggested but never came into force.
Okay. I think that's a very good question, Nathan. Let me just go back. Pillar 1 is composed of Amount A and Amount B. Amount A required the multilateral convention. It is the one that is related directly to the digital economy. It is the one where at least 60% of countries where the multinationals, the big multinationals are coming from, needed to be signatories and ratify the convention. Unfortunately, US has had an issue with that. And because they hold more than 40, it means the multilateral convention cannot operate. Remember earlier we mentioned some of the best issues around digital economy taxation is to have a multilateral instrument. Let's have a worldwide supervisory body so that there's coordination and maybe there might be less tax avoidance and evasion. So this one is at bay for now. There are many people who believe it is completely dead. Others believe the US is just doing their, they're buying time and before they come up with a revamped Amount A, but we'll wait. It's a wait and see what happens next. Amount B is already part of the transfer pricing guidelines. If you go to the OECD transfer pricing guidelines, under administrative and simplification rules, I think that should be chapter 3 or chapter 4, Judy. Should be chapter 4, if I'm not wrong.
Yes.
You'll see Amount B, where we have APA, we have safe harbor, then you also have Amount B, which is a simplification of transfer pricing. We call it streamlined distribution safe harbor and such like. Pillar 2 is composed of global minimum tax and also what we call subject to tax rule. Subject to tax rule is a treaty-based rule. So all you need is to pick the model and use it to negotiate with other countries where you have a treaty. So that one is, you take it or you leave it as a country based on your circumstance. Global minimum tax, I think this is where the drafters must have been very clever. They said, you are not forced, there's no multilateral convention to implement global minimum tax. But if somebody else implements, under a gentleman's agreement, you should respect, okay, the other country's global minimum tax. And the global minimum tax operates funnily. Let me just explain this in a minute. If, for example, a company ABC has the ultimate parent company in the UK and has a subsidiary in Kenya, according to the global minimum tax rules, if ABC in Kenya pays tax below 15%, maybe the effective tax rate is 10%. If Kenya doesn't have the rules, the rules allow UK to collect the top-up tax in Kenya, the 5%. So it's usually the classical example of, if you don't tax, I will tax. And that is why Kenya felt, why don't we protect our tax base and collect whatever top-up tax that might arise from Kenya by implementing Section 12G. So that is actually what the global minimum tax is about under Pillar 2. And you can see it is also elective. Nobody is forced. There is no multilateral convention to sign. So the only instrument to sign, to make it to be effective was Amount A, which is still at bay. We wait to see what will happen in the next few years, or if nothing will happen at all. And I'm happy Mwalimu has already done something there for us to see on which countries have implemented it or not. So there's BEPS work and VAT. Not many people discuss this. And Mwalimu, there's a lot of effort in discussing DST and SEPT and Amount A and Pillar 1, but there's very little in the VAT front. And not many people know that Kenya, we collect 10 times in VAT from the same services compared to DST. When we collect DST of 1 billion, we collect, actually it's 20 times. We collect VAT of about 18 to 20 billion. And a lot of discussions, a lot of money, a lot of time is actually spent on direct tax. And it's the most emotive discussion. So sometimes we take a back step and feel like, is it the direction to take? Of course, looking at it from a revenue administrative perspective, we need to invest where we get more returns. Why don't we invest in VAT, get more returns compared to direct tax where we get not much? So VAT, of course, the OECD came up with a guideline on how countries can implement VAT on digital services because of a very simple example. If you look at Netflix, it's a service that is consumed by Kenyans. Without the law, under Section 5(7) of the VAT Act, Netflix will not be charging VAT. Let me use Judy, for example. If Judy was to come up with Judy Flex, okay, where she is also streaming videos in Kenya, when she reaches 5 million, Section 34 of the VAT Act requires her to register and charge VAT. So without the law on non-residents also charging VAT, what it means, residents' services will be more expensive than non-residents. Judy will be charging 16% VAT for you to go and watch Judy Flex or even subscribe. But Netflix will not be charging. That's unfair. It's actually, we'd say it's immoral. So this law was to ensure that VAT is charged to the jurisdiction of consumption, whether you are present in that jurisdiction or not present. But of course, there's also a very clear relationship between VAT charged by non-residents and also reverse VAT under Section 10 of the VAT Act. So there's a report there I've mentioned on countries that have implemented the VAT legislation. I don't want to tell where, but next week I'm also supporting an African country to implement VAT on digital services. So when we look at the legal framework of VAT on digital services, of course, there are two variants. Some countries go with B2C because B2B is already subject to reverse VAT. You can remember what is in Section 10, together with the Section 2 definition of what is reverse VAT or services imported into Kenya. So some countries have gone with B2C, some have gone with both B2B and B2C, and that is the space that Kenya is in. And there's a guideline by OECD on how to handle it with a lot of other rules that aligns this legal framework or the taxation framework with international best practice and the various VAT laws of the respective countries. And as I wind down, there's the issue of digital assets and blockchain. I'll not attempt to explain what hot wallets are, cold wallets, blockchain, peer-to-peer, decentralized finance, and all those kind of terminologies. But what I'm just saying is that Kenyans are transacting digital assets and cryptocurrency in large numbers. In fact, Mwalimu, I think this should be confirmed, but Kenyans have been found to transact up to 1.5 trillion Kenya shillings per year in Bitcoins, Dogecoins, Ethereum, Litecoin, and all those coins. There's even a time a Kenyan company was coming up with Kennycoin. Okay, there's actually a very interesting case on Wiseman Talents. You can check that on. There was a huge case on whether somebody who was providing Kennycoin or digital assets wanted to do an initial coin offer, and as to whether the CMA was supposed to protect the investors in that space. And of course, the court elaborately explained that yes, CMA had the mandate to regulate. And that case was then used when we were discussing as to whether if you are, facilitating Bitcoins and all that, you are a platform that facilitates transactions in virtual assets. Are those financial transactions, are they investments that are then aligned to paragraph 1 under part 2 of the first schedule, which exempts, financial transactions of banks, the commission and all those. There's a whole paragraph going all the way to about L on exempt services of financial transactions in nature. So you can also check that up on the Wiseman Talents versus Capital Markets Authority. Also a very interesting case. So people do mining. Mining is the process of coming up with these Bitcoins. They tell us that if you mine 1 Bitcoin, you need more energy, you need more computing power, you need more tech savvy Gen Zs to mine the next coin. I told you I'll not pretend to know how to mine or a lot in the blockchain, but you can see somebody in Muranga is mining Bitcoins. Judy, umeenda Muranga? Kuna mtu hapa Muranga akona Bitcoins?
Yes, actually they have a self-sufficient plant where they have a hydro plant that is used to manage the electricity. It is there.
They felt that Kenya Power is not very reliable because in mining, you need very stable electricity. Any surge, you go to zero. And it's become more difficult with every process. The long and short, there's a lot of use cases for cryptocurrency. People use it as store of value. You have the coins, keep them. But then I wanted to show you something as a store of value. You see, when the UN was urging us to tax crypto traders, but this is the more juicy one. Mwalimu, I was told in 2015 to invest in Bitcoin. In 2016, a Bitcoin was $952. That was barely 100 or so thousands. Imagine today, I've checked the price, and as at the time I checked, it is $74,000. You see how we don't want money.
You prevented yourself from becoming a high net worth individual.
Imagine, I will be a millionaire today.
Yes.
Anyway, they say the higher the risk, the higher the return. I was risk averse then. Now maybe I need to be taking in a bit of risk. But basically, when you look at the use case of the cryptocurrency store of value, so does then that beg the question of capital gains? There are people who use it to buy tea. I think there used to be a shop, a crypto shop where you can take your tea using Bitcoins. The unfortunate bit is maybe the tea was a number of Bitcoins. By the time you go there, it has gone down. Okay. And there are also those who are doing mining, whether they're in business or not. So the question has been, how do you then tax it? Many countries tax cryptocurrency differently. I think India has a very elaborate law on taxation of what they call virtual digital currencies. There is a CGT and there's also corporate tax. There's also a withholding tax of 1%. US, similar. Canada and UK, Australia, Brazil, similar. But most countries I see have gone the capital gains away because of the speculation, nature of the assets. Kenya introduced SEPT in 2023, September, 3% on any amount you were off-ramping or selling or trading or transferring. But the law was repealed in June 2025. So effective July 1, 2025, digital asset tax is no longer applicable in Kenya. And as master students, I think this is also a good space. You can actually do a thesis on whether it is time to have a digital asset tax or incorporate taxation of cryptocurrency in the 8th schedule for CGT, or it should be clearly in the law, or we don't need it in the law because Section 4 business income already takes care of them. So I think that is a discussion that can be had. Then we have a withholding tax on royalties. For a long time, there's been an argument on whether the software amounts to royalty. Several cases. I'm sure you know of 7C's case. I think it was one of the groundbreaking cases in Kenya. But there's an old case of KCB. Then there are a lot of Indian cases, very interesting cases on royalties, on whether software amounts to royalty. There was even a time, Mwalimu, I think when the Indian Revenue Authority could not hack the issue of royalty and software, they decided to put software as technical fees. And so the case was about whether software fits within professional, technical, or it's usually professional. The next one is what? When you look at the meaning of professional fees, it's professional. Technical is the third one. There's usually a third one, a second one. Managerial, yes.
Management.
It's professional, managerial, then technical. And then they used the language of interpreting laws. I don't know whether it's the language or rule of interpretation. I always don't know how to pronounce it, but I always call it Nosita Associ or something like that, where you look at associated words. And they lost the case again because the court said that managerial requires people. I remember my CPA when I was told management means planning, organizing, and all that. So it means there's a physical person involved. Professional, you cannot talk of a profession without having seen the professional there. And so technical must also be interpreted to be human involving. Of course, that is also a wide discussion. What does it mean that there is human involvement? At what point? Okay, and therefore they lost the case. And the UN, I think, did a very good work under the committee of experts to then feel like developing countries are the net payers for the use of the software. They should be entitled to some revenue. And therefore they proposed that the royalty definition, which has been there for a long time, copyright of a literary, artistic, or scientific, patent, royalty, brand, formula, process. Then you go to, the CSI, the commercial, industrial, scientific equipment. Kenya, we have a fourth, the use of or right to use or disposal of a commercial, industrial, scientific equipment or anything giving rise to royalties. So the UN, of course, went to Article 12 and specifically put software as part of it. And that is partly what we copied when we borrowed, when Section 2 was amended to onboard software. Whether they are part of treaty provision, that is a whole discussion about treaties. And then lastly, we have Kenyans who are also investing, in the gigs, content monetization, TikTokers. The Revenue Authority or the policymakers at Treasury felt, can't these guys also pay? Remember, they do the work or gigs to people outside the country. They are paid from outside the country. Some are paid in Bitcoins. How do we get visibility of those transactions? And that is why Section 10.4 came into being somewhere in 2024, December 27th, of course, revamped again in 2025, to now mandate the Googles of this world, the TikTok, the Meta or Facebook, and many other platforms to now deduct when they are paying content creators or any research work, the app works of this world, educational platforms. I don't know how that will span out, as a way of enhancing visibility of the sector. Okay, so this tax is not a final tax. So once, for example, TikTok deducts 5% on a TikToker, then they are also required to, file the annual return, claim the withholding tax, and if there's anything on top after netting off expenses, and remember expenses, Section 23A, together with Section 16.2C, requires that all your expenses must be on e-teams. Though I know for this year, we've given some stopgap measure by doing a listing, but that might not be there next year. So there's also strict rules around that, just to enhance that space. So with that, can I open it up for Q&A as I answer the question about AWS Cloud? Mm-hmm. Okay, so all this is about Section 10.4. So I'm just avoiding going into the slides and all that. You'll basically get that after this. So what I wanted to explain, what I've noted, Judy, specifically to your question, these non-resident companies, when they supply you with a service or a good, they insist that you don't withhold. In fact, they want you to give back their money as it is in the invoice, okay, including the VAT. So what taxpayers are doing, they do a gross up, withhold, and pay to KRA. To the non-resident, nothing has gone on their end. So they still come back and pay SEPT. So you find the same stream of income having both withholding tax and SEPT. But when you look at section 12E3, it's very clear of the Income Tax Act that where withholding tax applies, SEPT does not apply. So if you are paying for cloud storage, of course, there's also a huge discussion as to whether cloud storage is a software. Remember, we said software is software, whether it is proprietary or it is off the shelf, any software. I don't know whether that is also a huge discussion, especially to those who understand technology better. So assume then the cloud storage is a software which is subject to withholding tax. Then my answer would be specifically SEPT is not applicable because the law is very clear. But if it is gray as to whether cloud storage, the Microsoft Azure, the AWS cloud is not software and not subject to withholding tax. Remember, it's not technical fees, it's not professional, it is not an equipment, then SEPT will then apply. But I've explained how you see withholding tax applying and SEPT also applying. Taxpayers don't want to be told you got software as a cloud storage, and therefore you needed to withhold. The non-resident, because they are not getting any credit, none of their money has been withheld, they come back and say, oh, there's no withholding tax that was applied, therefore then let me pay SEPT. So that is how I would answer your question on the interaction between the two. Mwalimu, you can have comments, then we have questions as we run down. Thank you.
Okay. Thank you very much. Nicholas, Nickson, this has been amazing to get to hear this perspective on taxing the digital economy from a very broad angle, but also you making reference to the domestic law and showing us that comparator across domestic jurisdiction and global tax rules, which really sets into context what we have been discussing from day one about international taxation, right? So I would now open up the floor for discussion. If you guys have any questions, any clarifications, or you just want to brainstorm with the Nickson over the taxation of the digital economy, please feel free to have that discussion now. Or even if you have something that you've not understood and you would like Nickson to explain it again, this is the time to do so.
Allow me, Mwalimu, to ask a question or really just challenge Nickson now that he is in the working party 11 at the OECD on taxation of the digital economy. Given that the US is not really cooperative in this, and last I checked, even Japan was not really interested in this, why then should we tax the rest of the world to death, yet the big players are in the US, for instance, where the US is not cooperating? Don't you think it is best for now? We have to push the US to get into the table. What do you think?
Mwalimu, if you allow, Judy, is there a specific tax so that we give it context?
Yes, now that is the digital taxes and the SEP tax for Kenya, SNAP for Rwanda.
Okay. I think my comment will be very simple. When we introduce digital taxes, especially for income tax, SEPT and the DST and all that, or SNAP or whichever tax, basically we are not taxing Kenyans. We are taxing non-residents who are getting their income from Kenyans. And let me use the same example as Judy Flex. So Judy Flex, yes, Netflix. So Judy Flex is showing us, has developed movies People subscribe and watch, and you are in Kenya. And when you are in Kenya, basically what it means, leave the indirect tax alone, you will have to tax your profits at 30%. So Judy will have to do how much did I sell to the subscribers in Kenya and even outside Kenya, minus your expenses per items, have your right profits per section 15 and 16, and then tax at 30%. Netflix comes to Kenya, subscribers move away from Judy. Maybe Judy is still physical and the movies are not as diverse and as they would wish. What does it mean? Judy gets out of business. But all the subscribers have moved to Netflix. The money is still paid to Netflix. What has happened? The government loses the 30% from Judy and loses again any amount from Netflix. How do you ensure one, there's a similar level of competition for Judy and Netflix? Let all of them pay taxes fairly. That is one. Number two, because the government still has to provide social goods, Netflix should shoulder the movement from Judy to themselves. And that's exactly what has happened in a lot of our economies. Many people used to go to Kenya Cinema or go to where Pius Muiro is, it's called what? There's another cinema downtown, okay? Or you go to Odeon, yes, Odeon Cinema. Or you go to Fox, okay? Cinemas or go to whichever cinema. All those guys have stopped going to those physical places. They now watch at the comfort of their homes or wherever they are on Netflix. The government has to move with the movement in technology. So to me, ideally, we are not taxing Kenyans. The digital service tax, CEPT, are actually taxing the multinationals who are deriving income from our jurisdictions, have no physical presence, but need still to contribute to the development of our country. I don't know if there's a better answer. Mwalimu, maybe you can also weigh in.
No, I'm fully in agreement with you. And I just wanted to...
Yes,
please go ahead.
I have a follow-up question, and this is in relation to the earlier question. I'm just bringing it together. You see, right now, these companies, multinationals, do not allow their consumers to withhold tax on their fees or on their prices. So technically, the tax is not on them. Still, the common Kenyan is bearing the cost of topping up the tax that you talked about earlier. And by extension, I think we are defeating the purpose that we wanted for this, because by the end of the day, this AWS customer will have to withhold on themselves, by topping up, or KRA will come for them for not withholding. So it is a bit of a trick, and maybe Nickson, it's something you need to look into the policy on that. Yeah.
I actually agree with you. It's something that we have discussed and we are discussing internally. Sometimes it becomes difficult to meddle into private contracts. You know, there's a case law that told, I don't know which company was that, I'll get the case, that however difficult it is for you, then you have to pay. And you know, it says taxes are never fair, but it's something we need to check into because it is real and it might also be impacting on our taxpayers negatively. It's even possible that the non-residents might be taking advantage of the double tax that they never shouldered. So I think it's something that we are already discussing just to see what can be done, what policy measures will be necessary, of course, within the allowable space in tax to ensure that you don't shoulder tax that is basically not yours. But again, Judy, do you get to claim it in the financials? That is also another challenge. Because I don't know whether ITIMS or the non-resident invoice will support the top-up. So it might be an out and out without any other benefit from the taxpayer. But I also wanted to mention the issue of US. It's a political issue. It's difficult to push the US. Some of the policies, they move, then they withdraw. Okay? And if they withdraw, what do? The safest bet for countries, we continue with our unilateral mechanisms. If they come back to the table, we can sit down and agree on how to do a multilateral approach to taxation. They have done it to the amount A. I'm sure they also worked out on the UN convention discussants, and they continue to do that. The funny thing is, they waxed cold on the minimum globe tax or the globe rules, and then they came up with their own exemption, what they call side by side. They said now you can't tax US companies because we came up with CFC 1972. We've had guilty since, I don't know, 2009 or 10 after the financial crash, okay? And they have gotten an exemption. The only beautiful thing is Kenya went with the mechanism that only touches on resident payers who have a global presence. So we are not affected by the exemption on what they call side by side. But it's a discussion maybe we can have another day. Malemi wanted to weigh in.
Yeah, no, just before I weigh in, does anybody have any questions for Nickson? I'm just going to say, Afshin, do you have any question? I hope you finished eating your tea, drinking your tea.
The tea. I'm trying not to divulge any secrets, but actually, I was wondering when you introduced Pillar 2, and then you were talking about Pillar 1 and Pillar 2, and you said Pillar 2 has nothing to do with Pillar 1. But when we looked at that example with the 5 countries, you kind of brought them in together. So I'm wondering, at what point do those two relate? If they're so distinct, how is it that they are relating? I'm a bit confused on that point.
Nazir, I think you're introducing a very complex topic, the relationship between Pillar 1 and Pillar 2. Thank God Pillar 1 is not effective. So currently nobody is even talking about it. Yes, but if you look at Pillar 2, there's a whole chapter on what we call covered taxes. There's a chapter 2 on covered taxes, or Article 2, that deals with covered taxes, income tax, taxes from whatever nature, so long as they're taxes on income, including Pillar 1 taxes. So it means Pillar 2 already recognizes the interaction between the global minimum tax and any corporate tax paid, including paid under Pillar 1. So I think that is the kind of interaction that you do. But the mechanics, the thresholds, the companies that are subject to the tax are completely different. It's only that they were being discussed under what we call the digital economy. But basically, Pillar 2 has nothing to do with the digital economy, except for what we call the race to the bottom. Multinationals seeking to pay as low tax as possible. And it doesn't touch on just digital companies alone. It touches on all companies, as long as they have a P and they are resident in the jurisdictions. If they don't have a P, they are not resident, you don't tax under Pillar 2. But if they have no P, they are also not non-resident, they deal in the services under the scope of Pillar 1, then you tax them under Pillar 1. So that is the kind of interaction, but it's a bit more technical than that. I appreciate your question. Thank you.
Thanks, Nickson. That's clear.
Thank you so much. And probably maybe Maina Kelvin, would you have any question for Nickson, or maybe just your thoughts around the topic today?
Thank you, Daktari. I am still digesting the topic, and I think Bwana CM has done a very good job in introducing this topic. Perhaps you allow me to, first of all, digest more, and then I can have comments on the same.
No, fantastic. No problem. Thank you for that. And maybe if I just call upon one more person, Ruth Atambo, any feedback, any issue that you want clarified? What are your thoughts around the topic for today?
Thank you, Mwalimu. I think I have just been taking it in. There are questions that I have in my head. I think I will sit down and do a little bit more research, but have the presentation, and thank you for the clarity.
Excellent.
Thank you for the clarity, especially on Pillar 1 and Pillar 2. I was also like my colleague, but thank you.
Excellent. So you see, Nickson, I mean, this topic, when it comes to the taxation of the digital economy, is not something that is just easy and seamless to understand, because there's so much to be able to unpack just by starting to think about what are digital business models, the different kinds of digital business models, and the tax treatments around them at the global level, regional level, and also at the national level. And then we are seeing this contention at the political level between the OECD and then the United Nations Framework Convention on International Tax Cooperation that creates, further nuances into how we're going to be thinking about taxing the digital economy going forward. And before I come to Vic, because he has his hand up, I just wanted to ask you, now that we have SEP and Uganda has its SNAP, and I'm very proud that, you coined that term for the Rwandese. So next time I go to Rwanda, I'll just definitely brag about it. What would happen in the event Protocol 1 under the UN Framework Convention on International Tax Cooperation goes through, and then there's wide political recognition of it in terms of how to tax the digital economy? And if that protocol is not in alignment with Kenya's SEP, what does that mean for us at the national level? Do we then go ahead and repudiate that law and introduce whatever pillar Protocol 1 would be telling us on the taxation of the digital economy? Just your thoughts around this, and then think through that while Vic also comes in to ask his question, and then you can answer them both together. Vic, over to you. Okay, I did see his hand up, so I don't know if
I also saw his hand.
Okay, all right. Maybe he now doesn't want to talk, but maybe you can answer, and then he will come back to us.
Oh, he's muted. He's saying he's muted.
But he can unmute
Maybe
himself. Like, I can't do anything.
I also thought you can just unmute and speak.
Yeah.
Vic, just check.
Oh, let me make you.
I've asked you to unmute.
Yeah. Let me make him a co-host. He can unmute himself, and I think.
Okay. So Mwalimu, as he comes in,
yeah,
very many things come to mind when you look at the discussion. One, whom are we targeting with an internationally coordinated taxation of the digital economy? Are we targeting Kenyan domestic companies, Rwanda domestic companies, or we are targeting the multinationals? Because I know we'll not rival the tech companies in this one. Okay? So if we come up with Protocol 1 that requires that we do SEPT, is the US who houses these companies, and China, and also maybe a bit of Europe, are they going to allow that mechanism of taxation? Okay, that is one. Two, who is going to coordinate the process? Because whoever coordinates the process must have ability to force the companies to certain things, open their books for audits, review whether they are paying their fair share, and then give this information to the respective countries. Then number three, is the protocol going to work on treaties between countries?
Yeah.
Okay. If it is a protocol that affects treaties between two countries, like, the usual committee of experts, what they churn out is a model. So if we want to negotiate with so and so country, we can sit down and agree. Let me give you one of the, I don't know whether to call it oxymoron or it's a very different angle.
Yes.
The UN gave us a very good Article 12B. And we know that treaties themselves don't give rise to taxing rights. So you need to have a domestic law aligned to the treaty article. Then now it gives you a taxing right, and also now curtails your taxing right. Our neighbors, I hope we don't have majirani in this forum. They were told to incorporate between their treaty and Oman Article 12B.
Yeah.
I don't know which year they will have any digital services exchange between Tanzania and Oman. Okay? Because treaties are negotiated in a very strategic manner. What exactly do you want? Then number two, do they have a domestic law aligned to Article 12B that in any case there's exchange of digital services between the two countries, then they're able to use the treaty. So those are some of the questions that will beg Protocol 1, and of course, the drafters, and I'm sure you are there, really need to think through it. Because alternatively, you might have a good protocol, a good document, but not implementable. Why? Because the countries where you should implement the source and the source countries and the resident countries are not aligned to what you're doing. And unfortunately, there's very little intra-Africa trade.
Yeah.
Especially on the digital front, it's not much. Unless you look at a software coming to Kenya, then Kenyans then on selling it to Rwanda. You'll actually be affecting the two countries without affecting the owner of the software who is somewhere in the US or in China or in Huawei. So to me, that will be a very important discussion to have, in addition to the fact that are countries willing to be coordinated? Because if each country is going to have their own mechanism of taxing the digital economy, then what are we discussing at the end of the day? We cannot even coordinate and harmonize those kind of rules. So I think Protocol 1 and also the framework, actually to me, the framework is more important than even the protocols. The framework on how binding is it to all the stakeholders, so that when you start discussing any protocol, it fits into the framework itself. But I leave it there.
Okay, what I'm going to do, we're going to have a different discussion on another day about the UN Framework Convention, because I hear you, but I have a very different point on the Framework Convention. I think the Framework Convention is very light, and it would not create like real binding commitments, because the states are moving serious commitments into the protocols and they're making them optional. So in my view, like, you know, having studied international tax from the historical origins of it, I'm just seeing this design of the UN Framework Convention is being structured in a way that it's going to have no real value going forward. Because if a state opt out of a protocol and you don't have substantive language in the Framework Convention, then we have no global tax rules. And why I'm saying this is because if you look at the October 2025 draft of the Framework Convention, it actually had very strong legal provisions, and I felt like this is really good. But then when you looked at the January 2026 draft, all the heavy, substantive, strong legal language has been actually pushed into just discretionary language. So I don't know what happened. Yeah, I don't know what happened between October and October 2025 and January 2026 for them to be able to water down the Framework Convention. And this is where I kind of feel like the OECD is still very strong in terms of pushing back against certain countries. I don't know what kind of conditionalities were given to countries to be able to pass such a poor framework convention. But I think we can have a separate discussion on that, so that because when we go for the August negotiations, I don't know if again things are going to change fundamentally. So it started off well. Yeah, Nickson, it started off really well, but I was very disappointed reading the what you call this, the January drafts. Going forward. But thank you so much.
I think my comment would be this. I think there's a lot of underlying geopolitics behind the scenes. People are not negotiating in good faith, which is already against the Vienna Article 33, and 31, 32, 33.
Yes.
But what is critical? You know, the OECD has a law, and there's a way it feeds into the EU, so that any decision that has been made at the OECD level, the EU takes it as EU directive law, and it's binding on all countries. And you remember when Amount A was almost being signed into, a country like Greece started pulling back.
Yes.
And all they needed was financing from the bank. So finally, they got the financing and they said, now we are agreeing, you know. So there's a carrot somewhere, there's a stick somewhere yeah, to also push members into accepting some of, we cannot accept all of us, but something needs to push us into saying, however bad, however good, there's some people will lose. It's a negotiation, you lose. Some people will not get what they want. Others will, or you get little, but we all move in the same step. But if some people have, a lot of playing their cards under the table, then I think it's a wrong footing.
Yeah, understood. Thank you so much.
Yeah.
Now let's give a chance to Vic. Are you back? Oh, sorry.
Yes, I'm back.
Okay.
Okay, thank you for the discussion. I've been following. Kindly allow me to ask on the tax rate. Effectively, it's supposed to be 3% on the gross turnover. However, I'm unable to understand how the 10% kicks in normally and probably finally the 30%. I don't know how to place it. I would have thought the 3% should cover everything.
Vic, that is a very valid question. I don't know if you were there earlier. Let me give you the Nigerian scenario. Nigeria introduced SEPT much earlier than Kenya. Their SEPT says if you meet, I think it's $65,000. That's the threshold.
Yeah.
So then they have a threshold. We don't have a threshold. So which is equivalent to so many naira. It's about 4 million naira or 8, between 5 and 8 million naira or Kenya shillings equivalent. So they say if a multinational meets this threshold, then definitely they are required to pay SEPT. How do you then pay SEPT in Nigeria? What the multinational needs to do, and let me use an example to make it simpler. Let's say it is Amazon. So Amazon, of course, meets this threshold in Nigeria. Once they determine that, we sold $2 million in Nigeria in that year, how do they then go and tax it? They need to go to their financial statements, consolidated accounts, and see what is their profit level from the business similar to what they're doing in Nigeria, maybe 15%. So once they determine the profit is 15%, then it will be 15% of 2 million. That takes taxable profits of 300,000. Nigerian tax rate is similar to us at 30%. So they'll pay a tax of 90,000 from what they are supplying. But this is real profits because they're able to say our expenses from the profits from the business in Nigeria is this much. Then, of course, they do attribution to know you attribute it to the extent of business in Nigeria, and then they pay. This has given them a lot of challenge. Actually, Nigeria, I think, collects less than half of what we collect in SEPT. Because one, they can't determine this 15%. How do you determine it? You must ask the companies to bring in their financials so that you verify. How will they give you financials that contain purchases from China, purchases from Ukraine, and all that? It brings a lot of data protection issues and it becomes muddy. So we decided that instead of asking the companies to come up with their own profits, why don't we give them a deemed profit? I mentioned earlier that SEPT is a virtual permanent establishment. It is separate from DST. So we said, actually, if you look at the bill, the proposal that year had proposed 20% profit rate. So we are assuming that out of the 2 million that Google or this company is getting from Kenya, they are making a profit of 20%. Of course, when it went to Parliament, they said 20 is too high. They reduced it to 10%. So I can confirm to you, 10% is not any scientific. Okay? We don't know what the wisdom of Parliament to move it from 20 to 10. But 10% was also used in the OECD amount A. So there can be that. You can also relate them, but I don't think there's any relationship. So we said, okay, we assume that you're 2 million, you make profit of 10%. Then to ensure that we tax residents and non-residents equally, we tax you at corporate rate. So corporate rate is 30% in Kenya. So that is why we come up with 30% of 10% of your profits. That gives you a 3%. So Avik, I don't know whether that is clearer now.
Thank you. It's clear.
Karibu. Yes,
Fantastic.
Mwalimu, we are
Nimeshukuru
good, I
sana.
think.
Yes, that was very, very, I think it was a very energetic session because as I was listening to you, and I think now I'm going to get a bit more academic here. So just please give us another 15
Karibu.
minutes because I wanted,
Okay.
something that you said at the start, and I love that comparison that you brought about in terms of TikTok, and you said that people are getting gifted lions, and then how does that translate into tax? Like, if it's like somebody's gifting you on TikTok using, I don't know, the lion, how did that classify as a tax treatment going forward? And as you were saying that, I was really trying to think about it because this is the reality of the digital economy. And you are
Correct.
right, influencers are earning a lot of lions and whatever other things that are there. I think I'm going to spend some time on TikTok to see how this works because I don't know because I know Afshin is on TikTok, so I don't know how many lions she has even gotten, so she can also, share her experience with us.
Judy has some diamonds. She earns
Oh,
diamonds.
wow.
Yeah,
Okay.
that's
Good to know. So now, I wanted to see this from a legal analytical standpoint, yeah. So and I'm glad that you brought it about. So just allow me to think through this, right? Because you have this
Yeah.
TikTok lion or diamond gift, and I think it sits very uneasily within our Income Tax Act because its economic substance is really not in the context of its nominal form. It's where you have a viewer. A viewer does not, if you think about it in any juristic sense, bestow a lion upon the creator, right? So that's the one conceptualization. You're not getting a real lion, but that lion is representing fiat currency. So you have
Yes,
this
yes.
viewer, the viewer is purchasing the TikTok coins with fiat currency. And then he's converting those coins into a virtual gift whose iconography, that icon, the lion or whatever, it carries a predetermined monetary value on TikTok's internal exchange. So it has a value, right? It could be maybe worth 1,000 shillings or 10,000 shillings or maybe 20 bob. I
There's
don't.
some worth 40,000. I think a lion is 40.
40,000. So that's
Yes.
the predetermined monetary value, which is on TikTok's internal exchange rate. And then TikTok is the one that's remitting it to the creator. What they remit is a residual cash sum after they have
Usually
deducted.
they withhold some percentage.
Yeah, that's the platform commission, right?
Mm.
Which I don't know what percentage they hold back. I don't know.
And you know the funny thing,
Yeah.
the transactions are then completed through Apple Pay and Google Pay. So they
Right.
also get their commissions.
That is true. So those are double layers of income that's generated by the platform and then by the person
Sure.
who's getting paid. So now when I think about the Income Tax Act, right, which proceeds from a schedule, what is this word? Scheduler, my English?
Don't worry.
Yeah, that thing. Yeah? It's 7:30. The scheduler
Yes.
consumption of income under Section 3.2, which taxing gains or
Yes.
profits from any business, employment, or even the exercise of a vocation. Now, when we look at the Kenyan jurisprudence, and we rely very heavily on the case of Scott versus Russell and Rio versus Hoare, right, to understand what constitutes income. So these
Correct.
cases tell us that receipts that are recurrent, that are connected to an income earning activity, and that are referable to services rendered or even content produced are revenue in character, whatever the label the payer attaches. So even if we say it's a gift, right? But when you look at it in terms of its predetermined monetary consumption, then it is revenue in character. So
The substance of the form, yeah.
So now a content creator who streams, performs, or even in any way produces material on TikTok is carrying on a vocation or business if we construe Section 3.2 really, really strictly. Yeah.
Sure.
The lion is remuneration for that activity, which flows directly from the audience, which is, the creator has cultivated the followers if they have like 10,000 of them. Then the gratuitous framing, it then collapses when we think about the inspection rule under Section 3.2, because since the payment is solicited, it is expected, and it has been monetized through that infrastructure designed precisely to convert attention into revenue. And I think that's what the digital economy is doing. When you talked about user participation, user attention,
Sure.
it's being translated into revenue. So now, even if we refer to it as a gift, And I know in Kenya we don't have a state duty, we do not have a standalone gift tax, but the income tax also contains no general exclusion for receipts that are styled as gifts, where those receipts arise from a trade, profession, or vocation. And I think there's also this case of Seymour versus Reed. It's basically the case that has distinguished, for example, personal tokens of esteem from payments and referred to it as the recipient's income earning activity. So I think that even if we say it's a gift and we want to strictly interpret that under Section 3(2), we can actually tax it as income. That's
looking at I would actually equate it to you going into a cinema theater to pay your favorite musician as they present. You take it anyway. I would have given more stories how I used to go to village dances. Now we used to pay.
Yes, I know you're a
But
good
Judy might
dancer.
take me to court, so let me leave it there.
No, I know that Nickson's a very good dancer. Don't ask me how, but that's a secret. And then the other thing I just wanted to also share with the class is that as we talk about the taxation of the digital economy, there are also things that are happening within transfer pricing. Especially in the context of algorithms. So there was somebody from PwC in Nigeria. We were having a discussion with them, and they were basically saying, how do we determine transfer pricing rules for companies that are engaged in algorithmic trading? So clearly, this issue of algorithms is something that we have to be very careful about as we think about the digital transformation, because it's become a business model. Initially, we were simply saying algorithms is what is based on machine learning. It improves user experience of a particular platform. But these algorithms have now become a business model, and companies are generating billions, if not trillions, in revenue, to the extent that now you're even having people from PwC think about how do we design transfer pricing rules to help us think about those companies that are trading in algorithms. So this is a really fascinating field. There's a lot that's taking place. And I think if some of you are going to be doing your LLM thesis, dissertations, this is a unique area where there is not much literature and understanding around how do we apply transfer pricing rules to algorithms. I mean, how do we first determine even the Dempe rules around algorithms? I mean, algorithms is an intangible, of course, but then when it comes to the Dempe analysis, if you remember development, enhancement, maintenance, and I don't know, those protection, exploitation functions, how do we try to create a sort of an apportionment methodology within Dempe to give us an understanding about TP rules around algorithmic trading? So I think, I don't know, Nick, if this is something that you're also thinking about at KRA, or it's on your radar, or, it's subject to just a wait and see approach going forward.
I think it's a very interesting area. It's only that I don't think our TP team has really picked it up, but it's something that we need also to check, and agree with you. I just wanted to add you one area as you are speaking.
Yeah.
We have also realized there's a lot of TP in carbon credits. All the functions are here, but the credits are being reported somewhere else.
Exactly.
So the trees are planted here, all the growing is here, but when the credits come, we never get a share. So there's also function analysis on carbon credits. It's also a very interesting area.
Yeah.
And I think because environmental sustainability is, there's a lot of research, it's also something you can look into. Thank you, Malim.
I'm just actually writing that down. TP rules. No, because that's a really important thing, because I think our government's vision is to go green in the next 5-10 years, and there's a big push towards it. So we really need to figure this out. So thank you for that. And then there was something else I wanted to say. And this is from the research work that I've now started focusing on. You see, initially when Nickson started presenting, he showed us a diagram about Amazon Web Services and, for example, the supply side, the clients, and then the user participation. And basically what that demonstrates for us is something called software as a service. because that is what these digital business models have conceptualized their entire corporate structure around. And then we are already thinking about the tax treatment of software as a service, what we are calling SaaS, yeah, SaaS. And that SaaS has always created a very difficult position when it comes to its tax treatment at the global level and, of course, at the national level. And just to give you a bit of context, not only KRA, but other revenue authorities around Africa and other developing countries, and even their courts, we've really been ping-ponging between characterizing SaaS payments, and by SaaS is software as a service, trying to characterize SaaS payments either as royalties or as business profits or as fees for technical services. It's just so difficult to say what form of tax treatment do we give this? How do we conceptualize and give a tax label to SaaS payments? Do we give them the label of royalties or business profits or fees for technical services? And the characterization in turn is going to determine then whether the source state retains taxing rights or whether the revenue basically escapes into the residence jurisdiction of the platform provider. And, Nickson talked about the OECD model. And there's a commentary to that, right? And basically, Article 12 of the OECD model, it's try to attempt to give us some sort of perspective on how to treat the tax liability that comes out of SaaS, like the standardized software access. And their Article 12 basically says if you have SaaS as a model, you're going to treat it, whatever income that's being earned out of SaaS or whatever profits are being earned out of SaaS, you will treat that as business profits, not as royalties, on the reasoning that the customer acquires no right in the underlying copyright, but only a right to use functionality. And then we go back to the arguments we had. If it is business profits, then we've got to now look at the threshold of PE, permanent establishment, under the OECD framework, and then that destroys the entire source country's taxation right around that. But there's a lot of discussion around this, and I think we also looked at this when we were discussing PE in our previous class. But going forward, we're not only looking at SaaS anymore, and this is where I'm now really trying to focus my research on. It's on artificial intelligence as a service. So AIaaS, right? Because if we're already talking about algorithmic trading, and now even Nickson is telling us there's carbon trading and the TP rules around it, what about artificial intelligence as a service? Because now this is creating more discomfort within the tax world, because we're not very sure what is the architecture that helps us respond to artificial intelligence as a service in order for us to provide a tax treatment towards it. The law, as of now, has not yet caught up. So there are three characterization problems that arise when we look at AI as a service, because AI is a service today. You heard Nickson start off by giving us, is it Domo? Did you call it Domo, Nickson? Where is it? Yeah, the Domo website that Nickson basically showed us, and you got to see a lot of activity in terms of what's happening on the digital economy, and that's artificial intelligence. It is a business model, so it is a service. So there are three characterization problems that arise if we're going to start thinking about how do we tax AI as a service. First, the object of the transaction is quite ambiguous, because you have a customer who's querying a large language model. You're using ChatGPT, you're asking questions on ChatGPT, but you're not purchasing software of ChatGPT in the traditional sense, even when you pay subscription fees. So it's not a discrete technical service that you're paying for, but it is a computational inference that is generated in real time from the model weights that are themselves the product of training on data whose provenance and jurisdictional locus are not being disclosed for us, right? So we cannot treat that as royalty. We cannot treat it as business profits. We can't treat it as technical services. Now, whether the payment is for use of a copyright asset, which is the model, OpenAI's access codes, or is it the service, which is the inference, that internet protocol that we're using to now log into ChatGPT and other such models, or is it access to a facility, which is the compute infrastructure, which is going to determine the treaty article that we're going to engage when we start thinking about how do we conceptualize artificial intelligence as a service, as a business model that can be the subject of taxation. So that's the first point of contention. We need to be able to characterize it, and that characterization is already difficult. The second thing is that the fees for technical services category under Article 12A of the UN model, and Nickson talked about this, it requires that services be of a managerial, technical, or consultancy nature. And if we can classify artificial intelligence as a service in the context of Article 12A, then we can actually say that it is a form of an automated and non-human nature of the service, which then brings it into the context of technical services. And we can then be able to basically tax that. If you go back to the Indian jurisprudence that we looked at, right? The Indian jurisprudence only mentions the word make available. That's the test that we're supposed to adopt in trying to assess whether artificial intelligence, not artificial software as a service, for example, at that particular point, could be the subject of tax treatment under Article 12A. And if we apply the same logic to artificial intelligence as a software, then we can actually say Article 12A of the UN model allows us to tax artificial intelligence as a service. And I think if you look at the De Beers India Minerals versus Guy Carpenter case, it can provide some sort of understanding on how to apply Article 12 to these new forms of digital business models that are arising every now and then. I think that is the only thing I wanted to touch on. The TikTok issue, the Google AWS characterization, and then not only thinking about software as a service, but going ahead to focus on artificial intelligence as a service, because these are real issues that we are going to be confronted with as digitalization takes a broader hold and a deeper hold into the Kenyan market. So that is it from me. Nickson, I don't know if you want to respond or if anybody else has something to say.
I think those are very weighty matters to look into. To me, they create potential research areas, but also for those who are in practice, these are live issues that we deal with every day, especially the issue of software. When you talk of software as a service, infrastructure as a service,
oh yes,
now it is AI as a service, or you are looking at the software. There's even data as a service that also comes into fray. So I think these are live issues, whether they are really software in themselves, whether there's the right or you take right to use based on the definition of royalties or not. And then I think it's very beautiful, I think, to hear from Mwalimu. How do you do DEMPE for AI, for data, and now for algorithms? Which are also very important, because a lot of the intangibles created in the digital economy actually come from the algorithms. Even the Uber surge pricing method, it's all about algorithms, which is also important to look at. So Malima, I agree with you. Some of these things require deeper understanding, deeper review, but we also have to be alive that they affect how we operate, either as a taxman, as a taxpayer, or as a tax consultant, or even as an academician.
Yeah.
Thank you.
Yeah. Thank you so much. The only thing I wanted to add on that is that we don't have to wait for the OECD to give us a handbook on guidelines on how to apply DEMPE to artificial intelligence as a software. I think all of you have the capacity. Maybe one of these days we can all decide to say that let's meet at the law school for even 2 hours, 3 hours, I don't know, on a Thursday or whichever day is convenient. And we can sit down together and try and build this particular handbook on guidelines, and then, send it to the OECD and say, this is the outcome of our international tax law class in terms of thinking about how to apply DEMPE features to now construe artificial intelligence as a service. I know we have the potential to do it. We just have to sit together and unpack, and we can invite Nickson to also come in and other experts so that we start taking charge of how we want the tax rules going forward to basically create that fiscal sovereignty for ourselves. And I think that is my big push in every class that I speak to and every forum that I engage in, that the rules must come from us. We can no longer be recipients, passive recipients of laws, of directives and rules coming from the global north going forward. So think about it. If that's something that you want to explore in your dissertation, it will be really, really great for us to do this together. I know it's almost 8 o'clock and we're tired. So if there are no further questions, let us thank Nickson for giving us his time and an excellent presentation, and then we can call it a night. There you go, Nickson. Everybody's clapping for you. Okay.
Thank you.
Asante, thank you, Ruth. That's appreciated. So Nickson, tumeshukuru sana. Thank you very much. The TikToker Afshin is saying thank you for the presentation as well.
Asante.
Definitely. So thank you very much, Nickson. I'll be in touch separately for further matters going forward. And to the class, thank you so much for spending your time with us today and listening in. Next week, we're also going to have a guest lecturer. He's called Dr. Matti Kohonen from Finland, and he's the director of the Financial Transparency Coalition that has developed methodologies on how to measure illicit financial flows. And the case study that he's going to present is on the fisheries sector in the international waters to show how illicit financial flows are taking place and how basically we can get to identify how IFFs happen in the international waters. And we already have at the Indian Ocean next to the Somali coast, where a lot of illegal fishing is taking place. So that's really going to help us contextualize to understand how illicit financial flows fits within international taxation and how it is actually being abused. So we're going to have him with us on Thursday, and then the week after we'll try and see if we can have the conversation on the UN Framework Convention and bring in civil society members to have that discussion with us. So that's all from me. Thank you very much. Good night. And oh, sorry, Lennox, you have your hand up.
Yes, sorry, Dr. I've been trying to raise my hand, but unfortunately I had joined on my laptop browser, so I could not find somewhere to raise my hands. Yeah, but I was really concerned about the carbon credit and the transfer pricing aspect of it and how that would be feasible, particularly given the fact that it is a service that we are, well, technically it's a service, looking at how it's structured, and given the approvals and the fact that these also falls under the international conventions, and when you look at it from a Paris Agreement perspective, and then when you look at it from a taxation perspective, are you going to tax the proceeds? And if so, are we trying to look at, for example, if I have credits accorded to me by NEMA, say 100 credits, each valued at say $1,000, so to say. I know that's a exorbitant amount. So where would the taxation be coming from? Because as a recipient locally, I would be getting that. But then I'm receiving the money, say, from Microsoft or Google, which is a foreign company, but registered in Kenya. That's actually a transaction I'm working on. So I'm really trying to understand how that taxation model would actually fall into the transfer pricing regime. Maybe if you could chime in for a few minutes, and then I will be happy to save my questions to next week to Nickson.
So Nickson, you brought this upon yourself. Now go ahead.
Very interesting. Actually, I think for the last 3-4 years, we have been debating on many people also confuse carbon tax and carbon credits. I know carbon credits are within the larger carbon tax, but they're not the same. We've been arguing on whether do we need a specific law on carbon trading. I think South Africa has something close, just to see how to work on that sector specifically. We still feel that if there are any carbon credits and you're earning out of it, it should be treated like any other business income. But it's in a very special kind of regime and sector. Mwalimu, we trained one officer for 8 months, I think was it in Finland or somewhere? When the officer came in, the officer took 3 months and was poached to another country. And so that capacity left us. So it's a very interesting area, very technical. But now to answer our participant, we noted that carbon credits don't just happen between entities that are not related. They also do happen between entities that are related. So look at it from a context of entities that are related. Maybe the entities in Kenya, they're either farming in the tea and they have been told to reduce their emission or to do carbon sinks by planting certain trees. And then there are certain credits that need to either go from them or come to them, such kind of a transaction. But all this is done with a related party. Then you want to check the functional analysis of that kind of a transaction. Where should more income be left, and where are critical functions then performed? The actual for analysis. So you look at it in that context. But I think it's a debate we can still engage in. Yeah.
Thanks, Nicholas.
Yes, Malemo.
No, thanks, Nickson. Lennox, is that helpful? Lennox.
Yes,
No.
I'm here. Sorry.
I'm saying,
I just wanted to ask. Sorry, Doctor. I just wanted to ask Nickson, what about where then it's a community-based project, and I have like.
Oh, I don't know. I can't hear you. Hello? Hello? Did you guys get to hear Lennox?
Mwalimu is breaking. I'm not able to hear him well.
Yeah, are you guys listen? Can you guys hear Lennox?
No, we can't hear him.
Lennox. Lennox is that student who, when you want to go and sleep, he decides to prolong the discussion.
Sorry, but can you hear me? I'm so sorry. It's because carbon credits are very. I think I have done like 2 projects so far, and they're very dear to me. So if there's a transfer pricing element, I'm really keen on understanding the mechanics. In my goal of becoming a tax compliant citizen.
No, I hear you.
Really, my question is, yeah.
No, I hear you. So let me
particularly for. Sorry, Doctor, maybe go first.
No, I was also saying it would be great, if you're to type it out on chat, right? Because when you're buffering, there's a lot that you're saying that is being missed out. So I also wanted to just give just basically on what Nickson had said. And if you allow me, I just wanted to. So I'm not a fan of carbon credit. And therefore, I don't like the practice around carbon credit. And that's why I chose not to answer it. But I think I just want to just speak to you on the TP part of it, right? Because I mean, when the way I think about TP, I always look at it from a step-by-step perspective. So the first part, when you're thinking about carbon credit transfer pricing, is to start by asking the question, what is a carbon credit for tax purposes? And this is where Nickson made a point, right? There's this contention around carbon credits and carbon taxes. So we've got to start and unpack that, because number one, different countries are going to classify carbon credits very differently. The way we think about carbon credit is not the same as the way in which UAE and China are thinking about carbon credits. So already that's going to become an impediment in trying to determine arm's length, because you do not have a semblance of the correct definitional term from the get-go. Now, you're going to have some countries that are going to treat carbon credits as intangible assets. Then you're going to have other countries, and I think this is Kenya and Nigeria and Ghana, we are treating them as financial instruments. But then you're going to have the US or other European countries that are going to treat carbon credits as trading stock or inventory. And then others are going to treat them, and particularly these are the Asian countries, they're going to treat them as government-issued permits. So now, if the first step in terms of determining carbon credit for tax purposes, the definitional alignment is not there, you already know that TP is going to be an impediment. right? And when it comes to majority of our African countries, we don't have a clear rule. So then the taxpayer is going to end up choosing the classification that suits them. And I think this is where advanced pricing agreements are very, very important when it comes to now engaging on this carbon credit transfer pricing, because the APAs can clarify for us the first step about how do we want to treat carbon credits for tax purposes. Then you need to then focus on what is this carbon project structure looking like. So I don't know what happens at the community levels going forward, but when you have like a joint venture where you're basically, trading in carbon credits, you've got to ask yourself, what's the project structure looking like? So usually you have a multinational company that's going to set up a parent, or in other words, what we call a holding entity. And usually that's going to be in a low tax jurisdiction, and low tax in the European sector, not Africa, because Africa, our taxes are not within the range of 10%, 15%, right? So normally the multinational will always be in the Netherlands, Switzerland, Singapore, and the Gulf region, okay? And then this offshore entity is going to sign a project agreement with a local entity in the source country and say that is us, Kenya. Now, the local entity through KRA now is going to run the actual mitigation activity on the ground, whether it is forest conservation that is happening in Amboseli, for example. And I think the University of Nairobi, our LLB students, they actually did a very good project when they went to Nyanyuki to go and understand how the forest conversation is taking place and the entire discussion around carbon credits. Their video, their interviews and everything is on YouTube. So that's it. The local entity is either going to be the forest conservation or what was taken out by Ruto recently, the cook stove distribution. And then in other jurisdictions, we have soil carbon. Now, in that particular context, if that's the structure itself, then the carbon credits are legally held by the offshore entity under the project agreement. It is the offshore entity that's going to be selling the credits on voluntary or compliance markets at a high price. The local entity, which is us, is only going to receive a small payment, and the communities, for example, whose land or labor that has made the project possible is basically going to receive very minimal amount. Now, that is the second part that we need to think about. The first was the definition. The second is now the structure itself. And then we come to TP and why TP matters here, because the transaction between the offshore entity and then the Kenyan entity, it is a related party transaction, because that's what TP is. TP is about thinking about related parties and then applying the arm's length principle. So now the offshore entity, say in Netherlands, and this one here in Kenya definitely meets the match of a related party transaction. Then the transfer pricing rules that are going to be required in terms of the tax treatment of these carbon credits is to be priced at arm's length. Now, the question is whether the small payment that is made to Kenya reflects real market value, or whether the profit is being shifted offshore. So that is the core concern when it comes to transfer pricing, and why transfer pricing around carbon credits is problematic, because how do you identify, or how do you put a price on that real market value? So what the transfer pricing methods tell us, and we did this, right? We did the profit split method, the cost plus method, I don't know, uncontrolled, whatever, all those things we were discussing in the second or third class. Now, if you're going to try and apply these TP methods, right, the comparable uncontrolled price method, it does not work. And I'll tell you that because carbon credits vary too much in quality, in methodology, in vintage, and also core benefits. And the market prices are usually opaque. We don't have a public database on how companies are pricing carbon credits going forward to be able to generate that arm's length under the uncontrolled price method. Now, if you think about the cost plus method, the cost plus method is only going to give the local entity a low routine return, which basically ignores the entire mitigation outcome that happens in Kenya itself, which is the conservation of the entire land, the trees that are basically here. Now, if you apply the profit split method, I think there you can get something. You can actually apply the profit split method as the appropriate method, because now both the parties, the offshore company and the one here in Kenya, is contributing unique value. But I don't know how the tax authorities are applying that. right? Because the point when it comes to carbon credits is that most of the profits always sit offshore. Now, if you're going to think about DEMPE, the DEMPE test, right? Development, enhancement, and all those things. When we come to the D, development of a carbon credit, it usually happens locally, right? And it happens locally because of that mitigation adaptation strategy that is being done here in Nanyuki, for example. And then the enhancement also, it happens locally because we're continuing to preserve the forest coverage. So it's an ongoing project management. When we think about maintenance is also happening locally because the community members, for example, they're continuing to guard the forest. They're not cutting the trees. They're not creating logs out of it. They're not disturbing the soil. They're just preserving the area as it is. So that's maintenance. And then we think about protection. Protection also happens locally because we will bring in people like NEMA and whichever other entity is involved in this carbon credits to monitor and enforce that those regulations are in place and there's no illegal illegal logging of the timber, for example. So in the DEMPE function, you are seeing the first 4 functions are happening locally in Kenya, but the exploitation, right, which is basically the selling of the credit on international markets, is not happening through Kenya. It's happening through the offshore company. Because if we did a proper DEMPE analysis on carbon credits, it would give most of that profit to our source country. But now that goes back to my initial point. How are we classifying carbon credit? If we're classifying them as intangible assets, then DEMPE can be applied, and DEMPE we can use DEMPE through the TP rules, and it can generate enough source taxation for us. But if we're going to classify them as financial instruments, we cannot apply DEMPE. For financial instruments, we either have to apply the comparable uncontrolled price, cost plus method, profit, whatever those things. Sorry, I'm just tired. And then try to figure it out. But those transfer pricing methods outside DEMPE would mean that TP would not give any value to Kenya going forward. So that is my understanding of carbon credits, TP, and how TP can be misapplied if we do not get the characterization of these carbon credits correct from the start. So that's my point that I want to make, Lennox, but I know you are the expert, so we are also happy to learn from you.
Mwalimu, I totally agree with your framing and how you have actually brought out the structure and the process from the definition all through to including DEMPE in the analysis. I think to draw a spanner in the works, I just say that recently there's been established a global carbon credit market where it's just like the open market where someone can bid and sell for carbon credits. So I think that is also another dynamic into the entire
and that's a fantastic point. That gives you a database. Yeah. My point is, if you don't get the terminology correct from the start, even that open database is not going to add any value. Like I said, right? If you're going to treat them, carbon credits as intangibles, then of course you utilize that open database to be able to now do the functional analysis. But if you're going to classify that as stock, then how are you going to use that open database to be able to now conduct a TP analysis? And say Kenya is applying it's defining carbon credits as a financial instrument, and say maybe the Netherlands is looking at it as a government security. How do we find that relatedness?
Yes, I see that, Dr. And thank you so much. I really appreciate the feedback. I will dig into it and looking forward to our discussions next week.
Yes, you just had to ask.
And I think as Rose puts it, language in international tax law is very key.
Yes. Yes, language is everything when it comes to international law. And next time you want to ask a very complicated question, ask earlier before the class ends.
All right, Dr. No worries. Thank you.
Most obliged. And Nickson, anything on your end? Sorry for keeping you for so long.
No, I'm good. No worries.
Sawa.
Okay. Yeah.
Thank you so much, guys. This was really amazing. And see you next week. Good night.
Good night.
Good night. Thank you.
Thank you. Good night.